Hello and welcome to Fidelity Connects. I'm Glenn Davidson. Today we're celebrating a milestone. Fidelity North American equity class has officially turned 10. In the decade since its inception, the fund has navigated a few small moments you may remember: oil shocks, trade tensions, a global pandemic, and a rapid rate hike cycle, all while staying true to its disciplined approach to investing across the continent. As our next guest looks back on the last 10 years, what lessons stand out? And how do those learnings shape his outlook for the decade ahead? Joining me now to reflect on all this and more is North American Equity Class Portfolio Manager, Darren Lekkerkerker. A reminder to please submit your questions via the Q&A box for Darren. Live French interpretation is also available by clicking the interpretation button. Darren, it's so good to be here with you.
Hey Glenn, good morning. I'm psyched to be here.
And this month, 10 years on North American Equity Class. Congratulations.
Thank you very much, right? It just feels like yesterday for me. And
the time has gone so quickly. Let me take you back a little bit and take our audience back a little bit. You started at Fidelity in 2004.
That's right.
And then in 2009, you took on the equity sub-portfolio of the Canadian Balanced portfolio.
That's right.
And then in 2015, then you started running global natural resources as well with Joe. And then in 2015, North American Equity Class was put together. And I recall there was high demand. For financial advisors that we talked to on the sales team were always saying, Darren's doing so well, he's winning all these awards, he's really contributing to the funds that he's part of. When is he going to have his own fund? And then it happened in 10 years ago. How did that all come together?
Yeah, so it does feel like it was just yesterday. And I think what happened was I wanted to have a standalone fund. I was excited to have a broader mandate that also not only included Canada, but also focused on the US, right? And I kind of thought, like, at that point, the US was doing well. The outlook for the US was really strong. Clearly, it's, US has done really well for the past 10 years and it's benefited the fund. The structure of the fund is 70 US and 30 Canadian, but there's a lot of flexibility. It can go to 0 Canada or 50% Canada, with the balance being US, and with I can add some global in there as well. So I wanted to have a broader mandate. I thought focusing on the US would result in better absolute performance. And I think just given the US has a higher focus on technology, healthcare, consumer, I thought that there'd be more secular growth and more innovative companies that would help me in not only in picking for that fund, but also picking for my Canadian stocks as well.
If we went up to the 9th floor with the cameras today and had a look at the Wall of Fame, the awards that the team that you work with has received is immense. You contributed to a lot of those awards. If it's A+ awards, Morningstar awards, Lipper awards. In fact, North American Equity Class won a Lipper award in 2024 for best 5-year North American equity fund. And Lipper award, meaning risk-adjusted returns, you must be very proud of that. What do all those awards mean to you?
Yeah, hey, thank you for bringing that up, Glenn. Yeah, I think so. I think my very expensive won 13 Lipper awards, and then it's won the Morningstar and other awards. I mean, look, like, I'm competitive. I want to win. I want to do a great job for the people that put enough faith in me to buy this fund or buy this fund for their clients. And so I'm glad that we achieved a really positive outcome. Over the 10 years, the fund's gross performance has been 15.8% per year, so compounded. And I think if you do 15, you double in 4 years, and if you do continue to do 15, you quadruple in 10 years. So the fund's done 15.8 on gross. So I'm proud of that accomplishment. But yeah, it's fun to win awards, and for the trophies, honestly, I actually just I award them to my kids. My kids are really little; they're 6 and 8, and so if they achieve something like on a math test, or if they do well in soccer, I actually just give them a trophy. They keep it in their room, and they're still young enough where they actually like that.
So your kids have won Lipper awards already. That's another topic. Yeah. So I think around 62 holdings right now. Let's talk about the makeup of the portfolio.
Yeah.
Is that something that's not an immense number, and it's quite concentrated? Is that something that you purposely aim for?
Yeah, I would like to have it greater concentrated. I think mathematically what matters more for your performance is what is your concentration in your top 10. And so for me, that's generally between 40 to 50%. So that's very concentrated, and having the top 10 ideas be that much. And like, these are ideas that I really like. They're high quality businesses, and we've done a lot of due diligence on them. Like my thoughts are like these 10 stocks will drive the performance of the fund. Now you're saying 62, that sounds a bit high. Generally, I would like that number to be between 40 and 50 positions. There are certain times where I'm getting into or out of names where it can be a little higher than that. So I will work to kind of probably trim that down a little bit.
Is there a mentor that you had in the past or currently that kind of led you down that path?
Yeah, so I'm super lucky at Fidelity. Like we have so many really smart investors here, and a lot of our viewers will know that. And so initially, like one of my mentors was Will Danoff. So when I was an analyst in Boston, my first job was covering Canadian consumer staples. Then I got Canadian healthcare. There was like 1 or 2 interesting companies and like 10 really bad companies. And so when I hosted these companies for meetings, almost no PMs would come, but Will Danoff came to every meeting despite managing like, many billions of dollars and being the guy at Fidelity. And so in my head, I was like, well, the reason he's the guy and his performance is so good is because of work ethic. And he's not just sitting in his office or going out for lunch, he's actually going to company meetings and doing the legwork. And so I tried to take that lesson into my own investment process. I think another person who actually was an analyst at the same time as me, we were promoted at the same time, is my friend Mark Schmel, who's obviously done extremely well. He's got more of a growth mindset, whereas I have more of a quality mindset. And I think one of the things that he's talked about is how he's the best person at selling stocks, and I've tried to learn that from him and not be that person that says, oh, I always sell too early, because like why would I want to give up performance for my holders?
And that brings up a great point about the time that you spend in Boston, and I'm glad you mentioned that because you were around. Even Peter Lynch was in from time to time. Joel Tillinghast there, Will Danoff, and so on. And then your own peers like Mark and others that you talked about. So that was really formative for you. And then the team all moved up here to Canada, which is awesome. The Canadian component right now is around 32% in North American equity class. And you said that can go to 0.
Yeah.
So why did you why have you got the 32% mix right now?
Yeah. And so one thing I want to point out is don't think of that as 32% of a Canadian fund. That's just like the best of Canadian ideas, and it's not going to be a full Canadian fund. So if I don't like a large sector of Canada, I just will not own it. And so that's not like 32% because it's some algorithm determined that that's the ideal number. It's more just driven by individual ideas. Obviously, Canada's been pretty strong this year, actually has outperformed the U.S. by several percentage points in both the currency and the index, and so there has been a lot of good ideas within Canada, whether it is Canadian banks, whether it's uranium has been really strong, gold has been strong. It's clearly volatile. It's been weak within the past last week, but and also like copper, and so there's a lot of good idiosyncratic. Also within industrials, there's a lot of good idiosyncratic ideas. And also retail.
Indeed, and so it's your highlight reel of Canada versus trying to say, I have to have this, but you could go to 0.
Exactly, yeah.
Do you find, I know we've seen this in the past, there's a brain drain from Canada to the US as far as companies being bought or people just migrating across the border to work for businesses in the US? And if you were only running Canadian equities, you'd lose those businesses. But now you can exploit them depending on which market they're in. Is that
yeah, I think you're right. Sadly, you're right for this country. I don't want to talk about too many things that are relevant to my expertise, but I think you're right. But I think also keep in mind that a lot of the companies that are listed on the TSX have a larger business in the U.S. than they do in Canada, and so that's something to keep in mind as well. But yeah, you are right that I can do that. There have been some Canadian companies that have gone back to the U.S. and then back to Canada again that I've owned.
But the good thing is you're finding wonderful businesses in this economy as well. Now, let's look at it from a tech standpoint. I think 70% of your portfolio seems to be focused on tech and AI right now. Do you want to talk about that?
That sounds a little high, but I think it's about 27% that's in technology, and then another sort of mid-teens or high-teens percentage in communication. So I would think but it is still high. I do like tech. So in terms of AI, I mean, look, it's a powerful theme for the economy and for the stock market, and it is driving a lot of the largest companies in the U.S. right now. Even this morning, we've had a new agreement announced between Microsoft and OpenAI that I'm still actually going through, but so far it's positive. As I got here, Microsoft stock was up a couple percent because it seemed like it was a big order going forward from OpenAI for Azure. But I think overall, I think that OpenAI is very positive in terms of demand. There's really strong demand for it. There's also really strong both on the application side, but also more so on the infrastructure build out side right now. And so we're seeing that not only in terms of NVIDIA and semiconductors and the hyperscalers, which is kind of what people most talk about, but also in some of the other areas that are supportive of that. So for example, the power dynamics, so nuclear, this morning there was a big announcement between the US government and Westinghouse, which is owned by both Brookfield and Cameco, of an $80 billion potential spend on nuclear reactors, with the US government even getting an potential ownership stake in Westinghouse. So there's lots going on, and so we're seeing that move stocks around in uranium, in utilities, in the power and electrification areas within industrial. So there's lots to look at and learn, and the fund has been positively positioned on this theme this year.
I must have been thinking about your top 10 as far as the 70%, because it's certainly skewed that way. Some may say an 18-inning baseball game's a little long. Some may say AI has run past where it should be. Do you still feel quite bullish on AI right now?
Yeah, I do.
And the data centers, you talked about uranium, you talked about nuclear. That makes me think of inputs into data centers, which are these 1 to 2 million square foot buildings they're putting everywhere over North America and so on. The inputs to that must give you a lot of opportunities as an investor.
Yeah, and so I would say in terms of the inputs, it's in terms of power and generation. So I think that would fall under utilities, uranium, and in the industrial in terms of power, and also in some aspects of financials in terms of financing it. And so those are, in some of those areas, the fund is invested. And like for me, like again, I just fall back to the process. Is this a quality company? We go through our investment process by interviewing the management team and asking them, how they're going to execute, how they're going to allocate capital, and so we try to do the legwork to own the best risk-reward opportunities and benefit the fund.
There's a lot of companies currently announcing job losses, and that may be because of where their earnings are, maybe because of other structural reasons. In some cases, it may be because of AI coming about. Do you see that as a valid point?
Well, there was an announcement last night by Amazon, which might be one of the things you're referring to unfortunately reduce headcount by a material amount. It was not at the warehouse, but in the corporate, so in the head office. I think in part it was attributed to AI. I think for them, the company's doing really well, but I think they're spending a lot on CapEx for the AI build out in terms of GPUs and whatnot. And so I think it could be a little bit for that, but also I think it's the Amazon ethos to always keep costs low, pass on that savings to customers, have higher customer demand, that sort of flywheel. But in terms of AI and job losses, it's a huge topic in the economy right now, and it's heavily debated. We have seen overall softer job numbers in the economy, but it's still, in terms of the U.S. economy, adding jobs right now. But I do think that it is increasing maybe the certainty or uncertainty of hiring needs in companies. That, and I think also the tariffs probably also makes people a little bit more uncertain in their hiring needs.
You mentioned tariffs. Let's go back to the spring, Liberation Day. Can you talk to our viewers about how I know you didn't anticipate what happened, but how you prepare for situations like that and what that meant to the portfolio and how you came out of it?
Yeah, so I mean, you had to start to think about that after the election in November of last year. It seems like it's longer than last year, right? I feel like so much has already happened, but last year. And then so ahead of the so-called Liberation Day tariffs in April, I went to a conference in the US that's hosted by our mothership Fidelity in the US. And they only invited like 4 companies. Us and then other large US companies like T. Rowe Price and Wellington. And so they invited the 20 largest consumer companies CEO only. So we did 1-hour meetings. We got it with our own team, 20 meetings. And so I felt like asking these guys not only about their company, but about the the economy and about politics really helped me to understand that at that time there was a lot of nervousness and uncertainty, but I also felt at that time that there is a political cycle. Midterm elections are coming next year. It is important to the White House to have the economy and the stock market on stable footing. And so I kind of felt confident, but heading into the April tariffs, I tried to minimize my exposure to companies that had direct exposure either through exporting or importing or manufacturing of goods, and try to focus more on companies with services. Even still, I mean, it was very stressful. I think there was 3 days in a row where the market went down like 5% a day. And I was able to pivot from that in April and May and reduce the sort of so-called tariff winners or more defensive or conservative companies, and to buy some of the companies that had their share prices beaten down. And so one of them, which I can mention, it's in my top 10, is Aritzia. It's a retailer which is well positioned, had a lot of brand heat at the time, has a favorable expansion into the US in terms of stores. They launched their digital app just this week, but the online sales on the website have been doing well. And so like that was one that had been smoked that I took a look at and was able to add to the fund. I think other companies that's in my top 10 were Shopify, which was killed because people thought, okay, this is gonna absolutely crush their GM, the gross merchandise value that's sold, that they take a take rate on. And so I was able to get some bargains, and at the same time I was able to finance that by selling some companies that had held up pretty well, I would say, conservative companies. So it's been a lot of volatility and stress this year for sure.
Do you hold a certain percentage of cash to take advantage with the volatility in the market? Do you hold that dry powder consistently, or are you quite fully invested?
I try to be fully invested. If I have a little bit of cash today, but it's more just due to repositioning of the portfolio. I think that it's hard. Like my goal is to compound at a really high rate through time, and I think it's really hard to achieve that if I have a lot of cash in the portfolio, because then it's just not working for the portfolio for the unit holders.
So what you'll do is you'll say, I can sell this to raise cash to buy that.
Right.
Or is there a better opportunity?
That's right.
Interesting that you went to that conference and it turned into a macro research trip for you. And you hadn't probably expected that, but good for you for looking at it that way. You're not a macro person.
No.
You're a stock by stock.
That's right.
Just like you learned from Will Danoff and others,
Yeah.
you're stock specific. But I got to ask, because I'm sure our viewers are curious, do you have a view on currency, just where the strength of the US dollar is? You do run a North American fund, and I'm sure people have questions about the US dollar relative to Canadian.
I'm not overly. I think right now the market is very bearish on the U.S. dollar due to a perceived view of the end of U.S. exceptionalism and the Fed starting to lower rates. I'm not bearish on the U.S. dollar. I wouldn't say I'm very bullish on it either. Like I kind of just think of it as being more stable from here. It has come down a little bit this year. The Fed has lowered rates and is expected to continue to lower rates, as other central banks around the world do as well. So I don't have a strong view. I think it should be neutralish. In the past, one thing is that the US dollar, it's been stronger, but it's also been less cyclical, which has kind of had the benefit of having less volatility on the returns on the fund. But in terms of macro overall, yeah, you're right. I'm not a macro person. I always have a macro opinion. And I think that if I do, it takes time away from researching individual companies, which can really drive the results of the fund. And I also think that over the past 10 years, if you were very macro invested, you probably would have been more conservative or defensive, and that probably would have been a big headwind for returns, because obviously the past 10 years have been pretty strong in the stock market.
It must be fascinating for you, though, being in a position as a portfolio manager where if you do need that research, it's there for you. If you want quantitative, if you want technical, if you want macro, it's all there. It just depends on how much you want to digest, but it's there to complement what your stock selection is really all about, isn't it?
That's right.
The world of resources.
That's
that
right.
you're in.
I think it's really hard to pick the macro in terms of either the inflection points, which is the most important thing, or even the individual asset classes. And I always say I think that individuals should pick managers over asset classes, and I think they'll get better results over time that way.
Because of global natural resources, I want to ask you about gold. Thoughts?
Sure. The gold's been incredibly volatile this year. It's still up, I think, up approximately 50% year to date. It went up, ran up, clearly in the tariffs, and then it really started going up about a week before, in August, before they lowered rates. It turned into a bit of a frenzy, maybe got a little speculative, and it's come down recently. I think that the bull case for gold of primarily US dollar diversification by central banks and individuals is still there. However, I think that it probably needs to consolidate and stabilize after its run up. And so that's hard for me to gauge when that will be. So I do continue to have gold exposure in the fund.
And copper?
So copper is a different story, right? I always find gold harder to forecast than copper just because gold is a currency.
Yeah.
So think of it as an alternate currency to fiat currencies, right? And part of the view for gold is like all the fiat currencies will be debased by populist governments around the world. For copper, though, it's an industrial metal, so you can actually forecast demand and supply. The big driver this year has been supply. There's been several big mines that are either shut down or not producing. So Cobre Panama, the first quantum mine in Panama, is not producing, and they're continuing in talks with Panama. There's been several mine disasters. Some of them have been tragic, with people killed in Indonesia, also in the Congo, and some others. And so as a result, we've had really reduced copper supply, which has moved copper from a surplus to likely a deficit. It just shows you it's really hard to produce copper, and the copper price is up nicely year to date. And so I think that's a pretty good story. I think there will be some demand from AI. I don't think it's that. It's probably only around 1% of demand, but if it went from 0 to 1, that's actually a material amount, but it's not the biggest driver, it's more supply.
You talked about some retailers that you got into after Liberation Day happened. Let's talk about the consumer. Are they over-levered today?
Yeah. So I think with the consumer, I saw a report by another firm, like a sell-side firm, that talked about the K-shaped consumer and how wealthy consumers are doing really well because the stock market's up, and so their wealth is up, their spending is up, and they're spending a lot. And then the lower income consumer is having a harder time. They are anxious about some of the things going on in the economy and a softer job market and softer wage growth, as wages had grown very quickly post the 2022 inflation. So I would say overall, though, I'm not that concerned about the consumer, but I do try to pick my spots, and I would prefer to invest more towards wealthier consumers where they're spending their money.
And housing?
I think housing right now is soft in both the U.S. and Canada. There's a lot of housing inventory. Prices are flattish to down, but rates are coming down, and so that over time that could be supportive. But I think in the U.S. a lot of homeowners are locked into low rates, and the rates need to come down a fair bit to incentivize people to be able to move again, to get out of their existing mortgage.
When I talk to you, I always recall early on in your portfolio management days, you talked very glowingly about railways.
Yeah.
That's not so much the case today.
Yeah, so CP Rail was a top 10 investment for many years. I bought that in 2011, shortly before the CEO change. And CP Rail went from the worst of the North American railways in terms of its OR, or operating ratio, was essentially its EBIT margin, to the best. And so I was super excited about that. It played out over a number of years. I would say that I do own some investments in railways again today, but it's a smaller part of the portfolio. I'm kind of like, I think they're high quality companies, good management teams. I'm just waiting for fundamentals to get a little better. Maybe we need housing and autos to get a little better, which have both been weak, and then you'll probably see more volume and pricing and some other benefits.
And what about the healthcare sector, Darren? Is that an area that you're exploring?
Yeah, so I think healthcare is one where I've generally participated through medical technology, but now I'm getting more interested in the life sciences tools segment. And so life sciences tools, think of them as producing the picks and shovels for the pharma and biotech sector. And so it's a good way to invest in pharma and biotech innovation without taking single drug risk, right? If they miss a trial, then you don't want to come in the morning and see your stock down 20%. And so these stocks were very, very strong up until 2021. What happened was during COVID, they really over-earned in terms of producing the test for COVID and vaccine for COVID. And it's been 4 years for them to kind of work this off. And I think we're there now. And the end markets are weaker, but they're starting to get better. And meanwhile, the valuations are a lot lower. So that's an area that I'm focused on, where I think it meets my threshold of high quality companies, and it meets my threshold of prospective 15. I'm hoping that it meets my perspective of I use 15% per year prospective returns. That's the minimum I want for stocks I put in the fund.
Interesting. We're getting close to time, so why don't we do this? It's been such a volatile 2025. In your words, what's it meant to you as a portfolio manager? Give us a summary. Give us the highlight reel, if you will, of 2025.
2025, yeah. It's every year I think is crazy at the end of the year, right? And this definitely was crazy, right? I mean, it kind of came into the year, everyone was very bullish, and then the tariffs kind of caught people a little bit by surprise, and the market really got crushed, right? But I think similarly, the comeback from that has also caught people by surprise. It's been very strong. I also think you have AI as a big thematic this year, which has really powered certain segments of the market. So it's been an interesting year, but it's one in that we do our core investment process of meeting with companies, talking with our analyst team, and trying to invest in the 40 best companies.
Okay, now, what are you looking for, observing, expecting, anticipating as we head into 2026, as we sit here at the end of October?
I think the outlook is good, Glenn. So I think the economy looks stable. I think it looks decent. I think the AI trade at the moment looks strong. We are actually going to start, I think it's tonight and really tomorrow night, with all the sort of Mag 7 earnings, and so we'll see. We'll learn a lot in this next week, but that looks good. So far, company earnings in the third quarter have been really strong, stronger than the second quarter, which was stronger than expected. So companies are very profitable and in a good shape, and so I think it's a decent outlook that we have here. I think the valuation is starting from a higher point than I would like. But that's generally not a good indicator of 1 year forward returns. But yeah, so I don't know. I'm optimistic and continuing to look for the best companies.
That's well put. Fair enough. Thank you for that. And I would say you mentioned earlier that this year has gone very quickly. 10 years has gone very quickly, as we said at the outset.
Yes.
Congratulations again on 10 years
Thanks,
in North
Glenn.
American equity class. It's amazing. The performance has been wonderful. The awards will keep coming. Your children will have more awards to put on their desks, I'm sure. But again, congratulations from all of us, and we look forward to many, many more great years and awards to come.
This has been great. Thank you very much, Glenn. And
Thank you, Darren.
Thank you for listening.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.